Alright, quick CoreWeave update, because CRWV has been under pressure and I don't want to guess. Today I'll break down the real reasons the market is punishing CoreWeave, what changed recently, and the exact checklist I'm tracking before I call this a dip or a falling knife. Here's what we'll cover. 1. What the market is actually worried about, not the loudest headlines, the real fears. 2. The newest, verifiable updates moving the stock, the financing headline, the analyst reset, and the execution headlines. 3. The investor framework. What would make this a buy-the-dip setup, what supports a hold, and what could drive further downside. And finally, a simple checklist you can track quarter by quarter so you're making decisions based on facts, not noise. Everything I'm saying is based on published reporting and the company's release, grounded in what we can verify, not rumors or social media drama. And if you only remember one thing from this video today, follow the checklist, not the emotions. Let's start with where we are. CoreWeave has been sliding for multiple sessions in a row, and reporting says the stock is now more than 60% below the late June peak. That's a violent repricing. As I'm recording, CRWV is trading around the $70 area, give or take, after tagging the high 60s intraday. The point isn't the exact penny. The point is, sentiment has flipped from growth at any price to prove the economics. So what's driving the sell-off? I think it comes down to 3 pressure points that stack on top of each other. Pressure point 1, capital intensity and the AI returns debate. CoreWeave is not a pure software story. It's an infrastructure story. AI compute demand can be strong while the market still questions the return profile. Investors are focusing on the cost to serve demand: data centers, power, cooling, networking, construction timelines, insurance, GPUs, and the capital required to keep expanding. When the market is confident, people call that capital spending a moat. They're building ahead, they're winning share. When the market is nervous, they call the same thing a risk. They need constant funding, returns might compress, and this could become more commodity-like. That tone shift doesn't just hit CoreWeave. It hits the whole AI infrastructure basket. CoreWeave gets hit harder because it's a clean proxy. When the theme is hot, it flies. When the theme is questioned, it drops fast. Pressure point 2, financing overhang, the convertible notes. Now let's talk about what's specifically new and tangible, the financing headline. CoreWeave announced a proposed $2 billion convertible senior notes offering due 2031, and then the deal was upsized and priced at $2.25 billion, carrying a 1.75% coupon, due in 2031. Why does that matter? First, convertibles can create an overhang. Investors worry about future dilution if the stock rebounds. Even if that dilution is later, the market prices the possibility today. Second, it signals that the buildout is capital hungry. That is not automatically bad. Capital access can be an advantage in a land grab, but in a risk-off tape, the market punishes anything that requires repeated visits to the capital markets. Here's a trust-building way to say it. Funding is not good or bad by itself. The key question is whether CoreWeave can fund expansion in a controlled way without constantly surprising shareholders or weakening the balance sheet at the wrong time in the cycle. Pressure point 3, execution headlines. Scaling is messy. In software, you scale by shipping code. In data centers, you scale with construction and power. So when headlines pop up about delays, even delays driven by weather, the market takes it as a reminder that this business can hit real-world friction. Recent reporting described delays at a major AI data center complex in North Texas earlier this year, linked to rainstorms and other changes. Whether you view that as normal construction noise or a warning sign, the market is clearly treating it as another reason to discount the near-term story. And in AI compute, reliability matters. Customers don't just want GPUs. They want predictable capacity at scale. Now, 2 things amplify these worries and make the tape feel worse than it might otherwise. Amplifier 1, the short seller narrative has momentum. High-profile criticism from Jim Chanos is being repeated in headlines. This isn't about agreeing with him. It's about what happens when a famous short thesis matches the market's current fears: capital-intensive, potentially commodity-like returns, and lots of hype priced in. Short sellers don't need to win the argument in a week. They just need to keep the market talking about risks while buyers step aside. Amplifier 2, analyst resets are confirming the mood. Mizuho cut its price target to 92 from 120 and maintained a neutral stance. That matters because it signals the street is moving into show me mode. The message is basically, the platform is well positioned, but there are constraints, especially customer concentration and near-term revenue upside being less certain in a capacity-constrained environment. Again, that's not a hate call. It's a confidence call. They want clearer proof. So now, the question your viewers actually care about. Is this buy the dip, hold, or crash risk? Here's how to answer that without guessing. The dip buy case. What needs to be true? A dip buy is not it fell a lot. A dip buy is the market is overreacting while fundamentals stay on track. So what would you want to see? 1. Capacity continues to come online on schedule. Fewer surprises. Fewer delays. 2. Utilization stays high. The GPUs need to be working, not sitting idle. If utilization is strong, the revenue engine stays credible. 3. Unit economics hold up. Investors want confidence that margins don't get crushed by costs, insurance, or build-out inefficiency. 4. Financing looks planned and controlled. After the $2.25 billion convertible is priced, investors will watch whether CoreWeave can execute without constantly raising again in a way that spooks the market. If those conditions hold, then yes, a 60+% drawdown from the highs can improve risk-reward versus peak hype, because you're buying after valuation compresses. The hold case. How to frame it responsibly. Holding isn't passive here. Holding is choosing to stay in a volatile name while you monitor whether the thesis is still intact. If your viewers already own it, the right question is, did anything fundamental break? Or is this mostly sentiment and valuation resetting? If it's mostly sentiment and valuation, a hold can be reasonable, but only if they understand what they own. A capital-intensive build-out story that can swing violently with headlines. The crash risk case. What could drive further downside? We also have to respect downside risk. Here's what could keep the stock sliding. 1. More execution delays, especially if they begin to impact customer delivery, revenue timing, or costs. 2. Tighter credit or higher financing costs. If capital markets get less friendly, the market will derate capital-hungry models. 3. Customer concentration shocks. If a major customer slows spend, renegotiates, or shifts strategy, the market will punish that quickly. 4. A broader sector unwind. If investors broadly decide AI infrastructure returns won't justify the spending, the whole group can stay under pressure longer than people expect. Now, here's the value you can deliver that builds trust. Don't try to predict the next 5% move. Give viewers a checklist and a framework they can use whether the stock is green tomorrow or red tomorrow. My 6-point checklist. 1. Capacity delivery. Are new sites and power coming online on time? 2. Utilization. Are GPUs staying filled with paying workloads? 3. Margins and unit economics. Are they holding steady as the business scales? 4. Financing path. After the convertible, what's the liquidity runway and what's the next funding event? 5. Customer concentration trend. Is dependence on a small number of customers improving over time? 6. Reliability and operational execution. Any recurring delays, disruptions, or surprises that change customer confidence? If those 6 items are improving, dips can become opportunities. If those 6 items are deteriorating, then it doesn't matter how cheap the stock looks. Risk stays elevated. And please remember, volatility is normal here, so manage position size and emotions accordingly. And I'll close with this. CoreWeave is still one of the cleanest proxies for the AI compute build-out. But the market is stress-testing the story, capital spending, execution, and returns. If CoreWeave executes cleanly and the funding path stays controlled, the stock can rebound sharply when sentiment turns. If execution slips or financing becomes a repeated surprise, the market can keep derating it. Not financial advice, just a framework. If you want, comment checklist and I'll pin the 6 points under this video so we can track it together quarter by quarter.